Great. So I think thank you very much and welcome to all the distinguished participants and our distinguished speaker for today, Huzeifa Unwala, a very competent, highly skilled, and a very good human being. You can, one of the few good people I know personally as a friend in the country, a very good, down-to-earth professional. So today is the 45th session in this series of Analytics Wednesday, which we are holding every Wednesday for the past 1 year, almost 1 year now. And Sama Audit Systems and Software Private Limited is really pleased, to have hosted so many distinguished speakers over the past almost 1 year, and a lot of participants viewing it here on YouTube, and also later on, since it is a recorded video is put on our YouTube channel, Sama YouTube channel, it is viewed by a lot of people later on. So this has become a great resource for people to learn about analytics from different speakers. As all of you are aware, today I'll take some time to just explain that IDEA, of course, is the flagship solution for analytics, which has been accepted across the country and even in the neighboring countries, even abroad. But from Sama Audit, we have been able to spread it in this geography, and it is being used by number of professionals, both in industry and CA firms, NGOs, the government sector. Apart from Sama, apart from IDEA, which is being used across, I think there are a number of other products or solutions which are available now, which have been successfully installed, used across the country again. So Smart Exporter is one such ETL for SAP, which has been used by a number of organizations, which is from Germany. We have from April 21 onwards, Sama Audit has added on Caseware Working Papers, which is the end-to-end solution for statutory external auditors. So 30 firms in India have already adopted the solution to be used, because that's a global #1 solution to be used by external auditors around the world, even adopted by the CPA in the US, in North America, and by most institute of professional organizations across the world have adopted Caseware Working Papers as the solution for being used by professionals for external audit. So I think we are pleased to represent that in India, and 30 firms have adopted that in this country also. We have got LSA, which is client server continuous control monitoring solution, which is available from London, which is by the Tier 1 financial services, company, which is promoting LSA, which we offer in the country, and there are a few installations of LSA also in the country. So I think that's in short what are the solutions being offered. There are e-learning modules so that people can, Sama Audit was the first one to launch an e-learning solution, e-learning training program on IDEA, because it's a low-cost training program for professionals, and no other distributor or no other geography can boast of having an e-learning on IDEA. So we are the only one who offers that in the country. Otherwise, most of them offer in-house training or online training, which is substantially costing much higher than an e-learning solution. I would also like to state that this program, though online, is being supported by the Government of Canada, the Trade Commissioner Service. And as the economy opens further, we would be hosting physical programs in the High Commission of Canada in New Delhi, as we have hosted in the past. I would now like to formally introduce Huzeifa Unwala. The topic for today is a little bit different, very interesting topic, which Huzeifa is going to speak on, which is framework of analytics for non-financial reporting disclosures. Now, I think very important, because I think that's the emphasis for a solution like IDEA, or for professionals who use analytics. Forget about IDEA, even professionals who use analytics, whatever solution you may use, I think it is important that you look at how you can use analytics for non-financial reporting disclosures. Very important. So I think I'll formally introduce Huzeifa now. He's a senior partner of JHS and Associates LLP. He's, of course, a fellow chartered accountant, a CISA, and a SMDP. He's got specializes in financial services and not-for-profit sectors. He has delivered client engagements in India and internationally in Middle East and US. His service specialties include implementation of corporate governance systems and policies, fraud investigations, statutory and internal audits, SOX, internal financial controls, ICOFA implementation assistance, SSAE attestations, and end-to-end enterprise-wide risk management implementation. So I think it's quite a lot, risk advisory as well as external audit. He is associated with private limited companies serving as a trustee director to assist the shareholders in completing voluntary liquidation of the company in India. And he is also associated with a charitable trust in the capacity of a treasurer on a voluntary basis. He acts as a board advisor to a startup in the space of e-learning and development. So I think with this a very short introduction to Huzeifa Unwala, personally, I know that he's got a vast experience, So over to you, Huzeifa.
Thank you, Deepji. Thanks for the kind introduction. And before I start the presentation for the day, I would warmly like to acknowledge that, you have been one person in my life where I look up to. And I fondly remember that 10 years back when I started the practice, I'd come to meet you and how you guided me on data analytics and my firm ended up working with your team, and we have immensely gained through the idea solution. And quite a lot of case studies that I would share today, they are actually coming out of use of idea software and the training that you have given to my young team. So thank you for that. And you have been a pioneer, and it's in this field of internal audit data analytics, and it's absolutely my privilege to be part of this forum today with you and with all the audience.
Thank you very much. Thanks a lot, Huzeifa.
Thank you. So I will share my screen. I hope I have the. Has it come up on the screen?
Yes, please.
Great. So good evening, everybody, and welcome to this session on Framework for Analytics on Non-Financial Information Disclosures. My objective for this session is to open up your thought processes and take you down to the detailing of non-financial information, which is emerging as a mega trend today, whether it is the annual reports, it is corporate announcements, it is ESG, or so many other facets as we would go through in the presentation. So what I've gathered for you today is a contextual framework of what is non-financial information, what does it comprise of, what are the various risk factors surrounding it, what are some global best practices, what does COSO talk about non-financial information disclosures and the framework to be followed. A proposed framework on non-financial information disclosures, which internal auditors could look at in the backdrop of data analysis, and then finally give you some concluding remarks in terms of what we could adopt as a framework and what are the do's and don'ts as far as analytics are concerned, and what could be the roadmap ahead. While I am taking you through the slides, there are 20-25 slides. It would be interesting if you have any questions to ask or any views to express, and that would make the session more interactive as we go ahead in our journey. The way it is structured is maybe for about 30 to 40 minutes or perhaps a little more. I would take you through the slides and the case studies, and then we can have a question and answer. So why non-financial information, or for that matter, all information, is becoming a huge mega trend? So somewhere in the last 3 to 4 years, we have witnessed that the performance metrics of organizations, which used to be a traditional one, the balance sheet and the profit and loss account, used to be the traditional performance metrics, has gradually shifted over a period of time in the last 3 to 4 years to new emerging frameworks like balance scorecards and several other enterprise performance systems, but not restricted only to the data that is being generated internally by the organization, but has gone much beyond that, encompassing data generated from sources of environment, society, local communities, and so forth. So there is a mega trend that has emerged. Performance metrics has shifted from profits measurement to stakeholder capitalism, that is local communities impact, employees well-being, fitness of employees. Pandemic taught us that customers, business partners, as well as environment. What are the key contributors to this entire mega trend that is emerging and that is, trending currently? Is there are huge environment concerns, climate change risks, billions of dollars of corporate revenues are at risk on account of pollution, CO emissions, toxic dumping, and so forth. ESG is driving corporate valuations globally, and at the last count, from the Japanese government, from US Parliament disclosures, etc., trillions of dollars are flowing into ESG disclosure and mature companies that have great ESG governance practices. Also, one key contributor has been loss of confidence on account of fraudulent financial reporting, where investors, stakeholders, decision makers, society as large has witnessed a trend on fraudulent financial reporting, which has eroded the confidence of public at large. And they're looking at alternative mechanisms to evaluate an organization's performance, and thereby expanding their horizons, going beyond the traditional balance sheet and profit and loss to actually the ESG metrics around employees, customers, business partners, and environment. The third mega contributor is technology, innovation, and acceptance of loss-funded startups, which we have witnessed even in India. There are so many unicorns that have suddenly cropped up on the horizon, and people are just not bothered, whether it is shareholders, investors, etc., board members charged with governance, whether a company is loss-making or profit-making. More important is the way it has innovated or created a product or a solution in the marketplace, and what is the market value of the company. So how do you measure performance of such enterprises? So all these things put together have contributed to this mega trend of non-financial information disclosures. We will get to the basic concept and definition of non-financial information disclosures also, but I would just like to make a quick disclaimer here that I am not a sustainability assurance expert. I am an internal auditor, having worked on so many NFIR projects in the past, especially in the domain of CSR. So all my case studies and examples will come out of social data, environmental data that I've audited in the past. So this image talks about climate change and the impact. No more we have spring, summer, autumn, winter seasons. We only have cold waves, heat waves, droughts, catastrophes, floods, etc. So I think the days of seasons have gone by. As we speak, we never imagined that in the month of March we could have 40, 42 as a temperature in a city like Mumbai. So it's amazing how climate change is taken over our lives and the impact that it is going to create. It's little unfortunate that on a lighter side, that if climate was a bank, it would have been saved by politicians and by global leaders. But the concern around climate change is more in words and in lectures than actually in practice. But I'm sure that we as audit fraternity can do a lot about it if we are changing our focus or little bit shifting our focus from financial reporting disclosures to non-financial information disclosures, which will go a long way. So the way we look at the red risks in the heat maps, we should also look simultaneously at the green controls that an organization has in the risk and control line items. So the moment the auditor's eye shifts on the green controls, I'm sure magic is going to happen here, and the right questions are going to be asked through data analysis, which the internal auditors or the auditors, external auditors will do, and there will definitely be a huge transformational change in the practices corporates are following as far as climate change risk management is concerned. When we pick up any annual report today, you will notice that there's a huge set of information download that immediately hits your eyes. When you look at the nature of information, almost 80% of the information is non-financial in nature. So people talk about the natural capital, human capital. They talk about manufacturing capital, intellectual capital, talk about CO reduction, waste management reduction, talk about sourcing from sustainable sources, employee fitness, health, mental well-being. They talk about business partnerships. So there are a lot of claims that are made in the annual report that go claims, promises, announcements, commitments, information in the nature which is much beyond the balance sheet and the profit and loss account. Now, is that information reliable? Is that information accurate? Is that information complete? Is that information complying with the laws of the land? Is the fundamental question which the internal auditor has to ask, and perhaps expand his universe to include the non-financial information related disclosures in the audit universe as one of the auditable entities, and develop a framework around that. So this session is all about that. What are the key drivers? So as IBM puts it, financial indicators are no longer sufficient and enough for decision making at the level of boards, stakeholders, and decision makers. Those organizations who are at the leading edge are using non-financial metrics to great effect. So from a valuation perspective, from an investment perspective, from a perspective of market capitalization, only those entities are going to be really calling themselves out are the ones who make disclosures around ethics, governance, climate change, employees, customer relationships, IPR, innovation, intangibles such as brands, quality, viability, risks, opportunities, and of course, social responsibility. So these are the 7-8 components which typically an organization would disclose from a non-financial information reporting disclosure perspective, bucketing into various types of capitals through an integrated report, or following a sustainability assurance standard or any other standard. There are 6 to 7 such frameworks available for making such disclosures, but the question remains that how reliable these disclosures are. So let's look at whether this mega trend that we are witnessing today is really adding value to the company or not. So this is a small research snippet from one of the leading mutual funds in the country on 3 parameters: risk, reputation, and returns. And on all the 3 parameters, organizations that are using non-financial information disclosures such as the ESG metrics and much more are really performing heads and above shoulders with as compared to organizations that are not using the NFI route. So this trend is only going to increase. So investors say that cost of capital reduces substantially if organizations are following sustainable standards, ESG. There is a robust improvement in operational practices of organizations. And of course, the market loves it, and organizations become the darling of markets if they follow non-financial information disclosures. So we as internal auditors really need to create a universe. It's a very complex universe of validating non-financial information. Again, an example from an annual report: organizations talk of purposeful people, trusted suppliers, committed partners, the way they are sourcing material, the way the business model is being executed, consumer insights, talent management, planet and society. And there is a metrics around each of these components that gets into the output and the dashboard, which the internal auditor can add tremendous value in terms of validating these outcomes, validating this information that is available, and giving assurance to the board and to the stakeholders. So coming to the famous fraud triangle, we have seen it in case of financial disclosures. Let's examine it in the context of non-financial information disclosures. What could be the pressure, opportunity, and rationale? This is summarizing the key risks that are emanating from non-financial disclosure, which will help us move towards a framework of designing data analytics around today's subject. From a pressure perspective, there is tremendous pressure for green investments. all mutual funds, all institutional investors, private equity players today are demanding ESG metrics, are demanding a metrics beyond the financial balance sheet and profit and loss account. This creates tremendous pressure on corporates, on companies, on entrepreneurs, on startups to perform and to show that they are going the green way. So this pressure is a similar type of a pressure from a financial reporting perspective, where entrepreneurs have to show a rosy financial performance. Likewise, they have to show a rosy green performance. Then there is shareholder activism, very evident in India as well as globally, where shareholders are calling out companies that are generating more pollution, calling out companies, filing lawsuits against the companies on various environment concerns, negative media reports, and climate lawsuits. If you just look up the statistics of the Green Tribunal in India, there are about 30 to 40,000 lawsuits in the country that are, under the nose of the Green Tribunal Act in India. And, at any given point in time, 3 to 4,000 tribunal cases are pending. So there are so many businesses that run the risk of actually stopping their operations on account of not complying with pollution control standards in India. Opportunity is that since there is low regulatory oversight, there are no universally acceptable standards to monitor and measure non-financial information reporting. The concept of greenwashing is taking over pretty quickly. What it means is that organizations are inflating and misleading environmental claims. They are indulging in abusive marketing practices where they call out their products and solutions as green without any evidence of they being so. Sustainable product benefits are being projected and promoted in the marketplace without any clear evidence of they being compliant with the various compliance standards. Manipulating non-financial data is very easy. It's a single entry system, not like the accounting system where there is debit and credit. So there is first leg and second leg, and automatically things are under a rigorous verification process. Financial reporting has stabilized over the last so many decades, and there are enough checks and balances now in terms of maker, checkers, verifiers, and approvers. But when it comes to non-financial information, the value chain of approval is not very robust, not very comprehensive. So manipulating non-financial data in public announcements is very simple. It's quite easy. And there are n number of examples that you can look up. Just do a search on Google in terms of frauds on greenwashing, and you'll get a spate of companies that have indulged in greenwashing. From a rational perspective, since there is no central regulation, it's all scattered. There is no oversight mechanism, just as we have from a financial regulation and financial reporting perspective. We say, for example, have the internal financial controls regulation, the CARO regulation, which actually gives rigor to the entire process of financial reporting, which is not the case as far as non-financial information reporting. Any questions so far from anybody?
No, I don't think any questions are there so far.
Okay, great. So I'll move ahead.
Yeah,
what are the fundamental questions that we need to ask ourselves, given the context of non-financial information reporting that we just discussed? What constitutes non-financial information reporting? Is it something that is written and published? Is it a corporate announcement? Is it something which is published in the annual report? Is it something which is there as disclosed on the website of the company? So we really need to, because it is scattered around all these areas. So the policy and the framework has to be very clear from a data analytics perspective, that what are the sources of information which the auditor is going to use for analysis. Then are the non-financial information disclosures subject to the same set of rigor as financial regulation? Yes, no, not applicable, depending on the philosophy and the management style of the organization. What assertions or claims are made by the management, and what are the internal controls around such disclosures? Are there internal checks and balances? Like, say, for example, if the CEO of a company is going to make a major product announcement, so is it validated from an internal control perspective in terms of reliability of information, completeness, giving a fair, balanced view on positives as well as negatives of the product being green? What is the policy to identify reporting problems in non-financial disclosures, checking them, correcting them, and then redisclosing them? So these are some fundamental questions which can come into the framework and the policy while we design the entire NFIR framework. This chart comes out of the integrated reporting framework, where it talks about 6 elements from a non-financial information reporting perspective, about the talent, employees of the company, customers, suppliers, business partners, communities, and other components. So we as internal auditors will have to look at the gamut of all these components from a non-financial information disclosure perspective while we design a framework and we implement the building blocks around the framework. As far as non-financial information reporting is concerned, we can summarize the scope into activities and communication that stakeholders would believe generate, preserve, and erode value. So it is not only generating the non-financial information disclosures, it is preserving, which means from a risk management perspective, protecting the quality of disclosures and disclosures that also may be negative in nature that erode the value of a company. It could be considered in the entire NFIR framework. So these are the various forms of capital that generally get reported in an integrated report. I mentioned a few of them initially in my few first slides about intellectual capital, innovation, human capital, code of conduct, ethics in the organization, loyalties and motivations of team members, the physical capital of the company, buildings, equipments, infrastructure, social and relationship capital in terms of the various shared norms, value systems, stakeholder relationships, strength of the brand valuation, and of course the natural capital around usage of air, water, land, minerals, forest, biodiversity, and ecosystem health. So when we talk of a framework, then we need to consider all these capitals that are being consumed and the value being created by the organization, and what are the types of inputs, processes, and outputs that an organization would execute to come out with a non-financial information disclosure. So to summarize, the entire framework can be bifurcated into 3 elements from an analytics perspective. First is the sources of information for producing non-financial information disclosures. Second is the actual process and production of non-financial information. And third is the external reporting and the compliance and regulatory filings which an organization does. So sources of information could be internal, external, could be competition from a benchmarking perspective, could be specific regulatory frameworks like the business reporting framework, business responsibility regulatory reporting framework. It could be quality certifications, product certifications by third parties. So all the sources of information that would get into the family of non-financial information reporting disclosures need to be identified and validated for originality. Then comes from a production perspective, organizations would look at the COSO framework, which we will talk about a little bit ahead as we go ahead in our journey in this session, to look at the entire objectives of the processing cycle of information. What are the elements of automated processing, manual processing? What is the quality of MIS? Are there any surveys that are being done to generate information? And what is the nature of reports? From an external reporting perspective, look at validating information coming out on website, annual reports, ESG, credit ratings, investor reporting, corporate announcements, etc. While we do so, the framework has to keep in mind reliability, traceability of information. So from where it started, where it ended, does it have an audit trail? Now, non-financial information has a very big challenge in audit trail because it traverses the entire organization. Take example of a corporate social responsibility program where the organization has decided to donate, say, for example, 100 crores towards a livelihood project in a local community. Now, the program has been implemented through an implementation partner, and the implementation partner has identified beneficiary communities who would benefit from the program of livelihood enhancement. Or say if a corporate has taken up the cause of doing operations, cataract operations, 10,000 cataract operations for a local community. You can imagine the diversity and complexity of information in this value chain, from sources of information, production, and final external reporting in the annual report of the corporate. So traceability of information is very, very critical for the analytics to succeed. And breaking down the entire universe of information into smaller chunks where we can validate data, we can compare the data, we can also test the consistency of data from a period perspective, from a nature perspective. So the framework has to comprise of reliability, audit trails, completeness, giving a fair view of non-financial disclosures, including positives, negatives, making it consistent with previous period disclosures, whether there are benchmarks, industry benchmarks, regulatory benchmarks, it has to be comparable. So again, a host of data analytics to be done around this area. Objective, it has to be definitely objective in terms of the information that is being generated. And finally, it has to be compliant with the laws of the land. So all these objectives have to be kept in mind while designing the entire framework. So let's take a cue from the COSO paper on non-financial information and the insights. So first of all, the COSO paper clearly talks about the scope of non-financial information disclosures. It says that any information that is being generated through a balance scorecard, enterprise performance system, ESG metrics, integrated reporting, or a performance dashboard of an organization should come within the scope and boundary of non-financial information disclosures. So that is very, very clear. So we as internal auditors have our work cut out now. Any information, or for that matter, all information beyond the balance sheet and the profit and loss that gets generated through these metrics or approaches should fall within the universe of internal audit. So COSO talks about creating objectives for data analytics for internal audit, identifying and assessing the risks around the specific target area or subject area, identifying control activities around it, and then evaluating the effectiveness, which is the traditional internal audit model that we follow. And the COSO cube also talks about control environment, risk assessment, control activities that we are quite familiar with, and breaks it down into a matrix format around environment, social capital, human capital, business model and innovation, and leadership and governance. So these are all the elements that can be considered within the program while we are designing the framework. Now, this is what is important from a materiality perspective. While we focus on non-financial information disclosures, because it's so vast and it's so diverse, how does the internal auditor focus his mind and attention on the material aspects? So this is a matrix which will help us focus our attention on what we could consider are key or significant aspects in non-financial information disclosures. This is what an investor or a board would be interested in. So they would look at a standard assessment on 8 to 10 parameters. So again, I picked it up from a public source, how mutual funds would look at investing in corporates and companies from an ESG disclosure assessment perspective. So is the industry resource heavy in terms of polluting, carbon intensity, high water usage, Are the company's assets exposed to areas of heavy pollution, water scarcity? How are the waste reduction targets drawn out by the company, and so forth? So these are all specific examples where the internal auditor can develop data analytics tests to check the traceability, reliability of information around environment, social, and governance and management issues to make the program effective and meeting the assurance needs of the investors and boards of directors. Now, I more or less completed the contextual and theoretical part. Let's get into the more interesting part of the session, which is talking about specific case studies. Again, these are illustrative in nature, may or may not come out of my past experience, they are largely around the social data landscape in our country. So the first one is again a case where a large set of beneficiaries were targeted by one of the corporates under their CSR program, where their key objective of this entire initiative was to identify what they called as poorest of poor and women-headed families. Women-headed families are those families where generally the male earning member of the family has expired, or is no more an earning member of the family, and the woman takes over. So the corporate was very keen to identify those beneficiaries and then create a program around livelihood, around sanitation, around many other objectives that they wanted, education, etc. So it was a very huge program covering large number of beneficiary families. So the starting point in the internal audit exercise was to really do thorough data analysis, because the universe of beneficiaries was running into lakhs and lakhs. And there is no way that an internal auditor can reach out to everybody and actually give assurance to the corporate that the benefits have percolated to the poorest of poor and have been percolated to the women-headed families out of the beneficiary universe. So although field surveys were done, field checks were conducted by the internal audit team, but the primary thrust in the internal audit was around the social data universe of the corporate. How the agencies have created the master data around the entire program objectives, what was the data around the beneficiaries that was collected, how the beneficiaries were targeted, etc. So what we did was we did a cross comparison of data. We did a comparison of data of the various hamlets, various villages that came under the purview of this program. And within those hamlets and within those villages, the population was stratified on the income levels, on the levels of ownership of land, on the levels of ownership of cattle. So various stratifications were done through data analysis to find out which were the real beneficiaries and which were not the real beneficiaries. And through this exercise, we could target and find out a lot of anomalies that, where money was wasted, by the corporate, thinking that, it was an efficient and effective donation and a social responsibility exercise. Large number of dummy beneficiaries were identified through data analytics. So before we even went into the household to find out whether somebody existed or no, we could identify that this was an affluent person who actually owned such a large piece of land and had such a large piece of farming income, but was still identified as poorest of poor or a woman-headed family. So here I would like to acknowledge that we used IDEA software for doing this analytics, and it came it gives us great value in all the analysis that we do in terms of stratifying the population, breaking it down into various tables, and then arriving at the final output. Even the universalization of the entire data is so easy while you use a CAD software like IDEA. So it really helps you pinpoint on exceptions. So this is one example. It also helped us identify a lot of defaulters, because see, when corporates try to do good to the beneficiaries, sometimes it's the reverse thing, that people who have already benefited in the past come in multiple programs again and again to get more benefits from the same corporates. So we try to identify people who have been already benefited in the past and trying to take multiple benefits through data analysis. So that was another output that came out of this exercise. and well appreciated. Next one was a project again for a corporate where they had a targeted segment on a livelihood enhancement for giving cattle like goat farming, poultry farming, etc. To families to increase their livelihoods and to increase their income earning capacities. So it was a program where the corporate was purchasing the cattle as well as gifting and donating the cattle in kind to the poorest of poor families. Now, in this, a lot of interesting analysis on data was done. First, on the age profile of the cattle. Second is the nature and the breed of the cattle, because the value of money depends on the age, on the breed, on the type of cattle. So a lot of analysis, just as we do on the procure to pay cycle, where we do analytics around the price that we pay to the vendors. It's something similar, where a lot of analysis was done around the poultry and the cattle processes of this program, again to identify huge variations, where the flock of cattle that was purchased and was donated actually didn't deserve the kind of price and the cost that was paid out by the corporate. So corporates, when they indulge in social activities, least realize the underlying risks, because they come with a mega objective of donating money and spending crores and crores and relying on a lot of agencies and NGOs and trusts, who in turn rely on a lot of grassroots level agencies, but they don't have enough of evidence to support what they have done. So when we do a data analysis on the beneficiary data, on the purchasing cost, on the distribution cost, etc., we come up with a lot of things. Even, for that matter, we identified from an insurance perspective, the cattle insurance costs that were committed and that were paid off, were on the higher side as compared to the underlying evidences that were available. So data analysis reveals a lot of important things. It reveals the truth in the underlying transactions. So this was on the poultry side. Now I'll come to the performance side, a few examples there. Like say, for example, in a broadband company that is providing Wi-Fi services, one of the key KPIs could be homes passed, whether a particular home takes the service or no, but is nevertheless surveyed. There is some pilot done, there is some modem installed, etc., and which they call it as homes passed key performance indicator. So when here you compare, this is an example of comparing external with internal data, where you compare the customer application forms with the homes visited, with the number of buildings, flats, with the master project plans, and of course do external source validations from Google Maps, Navi Maps, etc. You tend to find a lot of gaps, and a lot of value can come out in terms of a key performance indicator going wrong or being projected in an incorrect way. And this can really become very embarrassing for the CEO, for the board of directors, if say it goes into a IPO mode and a key performance indicator is disclosed in the memorandum of the company to investors. So non-financial information has the power to impact the reputation of the company immensely and take it down very, very quickly. So this is a performance indicator. Second one is from a banking perspective. See, there is a concentration of fixed deposits from a product analysis perspective in a bank. So again, banks and investors, board of directors will be very keen to know that what is the quantum of fixed deposits coming from which part of the company, from which branch of the company, within the branch, maybe the PIN codes from where it is contributing. So number of analytics can be done in this case also from a concentration of fixed deposit perspective, from a performance indicator. Any questions so far?
No questions, Huzeifa, but I think very interesting examples.
Okay. Thanks.
It's bringing to mind, since you asked about the question, there was another analytics which is in public domain, where they ran analytics in a state government, property tax vis-a-vis the number of electricity meters installed, So but for every property tax, is there a meter? And they found that the meters were much more than the property tax for properties. So what they came out was that they split the meters, ground floor, first floor, or 2 rooms separate, so that they could get that subsidy on the minimum electricity charges.
Yeah, absolutely.
So on and on, as you are relating the examples, you can relate it to number of analytics for the NGO sector, for the subsidies that the government gives, for the non-financial information which you talked about, Please.
Sure. So the next case example is, of a healthcare company. Typically, a healthcare company associated with hospital operations has got, a very large headcount. And, when you visit any hospital, you would notice that, there is a system of multiple shifts that, a healthcare worker would work, and is associated with a bed and associated with a floor in the hospital. So here, typically, there are legal non-compliances around overtime. So through use of analytics, because all these people punch in, punch out data either through biometrics or through overtime cards. So there is structured data, unstructured data. Very difficult to analyze this value set of data. But once you start putting in a trend of number of hours that the workers have put into work. So in this situation, we started trending the data. And over a period of 2 to 3 months, we realized that a particular worker has worked 125 hours in a week continuously, which is humanly impossible. So when you start questioning that kind of a thing, it is of course a legal non-compliance. But then there are no answers. So again, analytics wins the battle for you as an internal auditor in these kind of situations. Next is this is a case of actually employee frauds. See, under the marketing pressure, many companies and sales and marketing people are forced to create dummy data within the organization, especially where KYC is concerned. So while they are signing up accounts, like say in case of capital market transactions, stock market transactions, a lot of broker dealers, a lot of depository participants, etc. The marketing teams work on targets on a day-to-day basis. So they have to sign up a lot of accounts. Now, in the bargain to signing up a lot of accounts, people just end up signing the forms with their names and addresses and nothing else written on it. So this creates an opportunity for the field force team to start plonking in and filling in information which they don't have access to or which they are not aware. So when we ran the data analytics test on the KYC records of 13 lakh clients of a particular corporate, a broker, we realized that, fake email IDs were created with similar syntax. Active clients were with ages beyond 99 years. Mobile numbers of branch managers were identified as client mobile numbers. Wrong PAN and duplicate PAN numbers were identified, which is so common. Duplicate UCC were identified. So, number of things come out through, smart data analytics in a large volume situation. This is an interesting case again on open defecation, a free subsidy by the government. The government is giving a lot of subsidy and lot of interesting initiatives and schemes are being conducted, executed around the toilets initiative in the country, where villages are being declared as open defecation free. So in one of the instances where we did analysis of social data in one of the internal audit situations, where the work completion certificates were matched with the actual data around the open defecation free villages that were declared, and as output that was given to one of the corporates. We identified a lot of red flags in this scheme. Now, there are certain schemes here which require that the beneficiaries also contribute 100 rupees, 200 rupees from each village in the construction of the toilet, so that they actually go and start using the toilet. So to motivate them to start going and using the toilet. So we found situations where these master records, etc., were also assessed and evaluated, there were a lot of red flags that came out where actually toilets were neither constructed, the revenue that was shown to be generated from such smaller denominations was also dummy or fake in nature. So 3-4 more examples around social data analytics. One is that there are a lot of tree plantation and sapling programs that are initiated by corporates. And what happens is that corporates donate a large sum of money on sapling to be distributed free of cost to households, to families in the rural heartland. So here a simple analytics was carried out in terms of the beneficiary data and the land ownership of the beneficiary. So we found situations where the ultimate beneficiaries didn't own any land, but still the orchid saplings were supplied to them. So they had no place to actually go and plant the saplings and create a farm for themselves. So it was again a clear-cut case of fraudulent activity. Another case was around the water sanitation. Interesting case here that whenever a social responsibility program is conducted for water sanitation and water storage purposes, there is a process that is followed in terms of design, in terms of testing of water, sourcing of water, putting up the water storage tank or the water body, and then distribution and supply of the water. So in all these areas, we found weaknesses while we did the data analysis. One of the key areas that we found weaknesses when we compare control weaknesses was when we compared the water testing data with the number of storage tanks that were actually executed and implemented. And we found a gap there, that the testing records were not available for all the water bodies that were executed and constructed. So thereby the entire program came to a standstill or a halt, because when you don't test the quality of water, however good the storage body or the tank you construct, it is not then consumable by the beneficiary. Next is around education. So there are a lot of skill programs that are run in the country, and a lot of social programs around encouraging skilling of workers, skilling of students, making them job ready, giving them job readiness assessment services, etc. So there are a lot of NGOs working in this space. So a simple test of attendance records of people who have registered for such programs and when they have appeared for the exam. So the date of exam and the photo of the candidate. So if these three things are matched from a data analytics perspective, you would again come to know a lot of dummies in the data. So again, sitting at the corporate office in Bombay itself, without visiting the field, just matching the three sets of data, we identified so many students and so many dummy beneficiaries. And eventually the agency that was the implementation agency was called out and the program was terminated by the corporate. So this is a case of missing ATMs for a bank where we analyzed and compared the ATM rental records with the transaction logs generated by the ATM on a day-to-day basis. So again, a large set of data, almost 8,000 to 10,000 ATMs across the country. Transaction logs were summarized, compared with the rental records and the physical location records of the ATM, and found several instances where instead of ATM, there was something else, say a barber shop. If the ATM was located on the ground floor, it was not found, and then was found on the third floor, with a different rental arrangement. So a lot of things come out when a large set of data is summarized, organized, and analyzed in an effective manner from a non-financial information. Like just imagine the bank could have gone wrong in publishing the ATM statistics with this kind of a simple data analytics test. So I come to the last section of my presentation. First, left-hand side of the presentation talks about the sins of greenwashing. We have already seen few case examples. This is a terrific paper by Terra Choice, published 10 years back, but with some real gems in it for all the auditors that are interested in creating a framework around non-financial information disclosures. They should look at the 7 sins, which I would say are the top sins as far as non-financial information disclosures are concerned. First is the hidden trade-off, suggesting a product that is green or sustainable based on very narrow set of attributes without paying attention to other major issues. So any corporate that claims that the product is green, like you had these automobile controversies, automobile industries, you had companies like very big multinational companies claiming their diesel engines were actually fit for purpose and were less non-polluting. But when the testing of the products was done in the laboratory, it turned out to be the other way around. So there is always a hidden trade-off between the claim made by the company and what is the actual truth. So internal auditors should be very careful about such product claims. No proof. Green and or sustainable claims cannot be substantiated by easily accessible, reliable information by a third-party certification. So where there is no third-party certification, the internal auditors could step in and create sufficient controls and evidences to support the claim of the management. There is some element of vagueness in the claim of the management. The claim is poorly defined or so broad that the real meaning is misunderstood by the consumer. Irrelevant claims are made around environmental and sustainable matters by organizations to just mislead society at large. Then there is always lesser of the two evil. Within the product or service category, environment or sustainable claims may be true, but may distract consumers from the greater environmental sustainable impact of the category. For example, organic cigarettes. So cigarettes are injurious to health. Now, even if you are an organic cigarette manufacturer, the way you market yourself is at the end of the day, you still end up harming somebody's body. Next one is fibbing. The environment sustainable claims are simply false, where organizations fluff their way, which is the least frequent form of greenwashing. And last is worshipping false labels. Either through words or images, it gives the impression of a third-party endorsement, even though such an endorsement does not exist. So like a government agency having given a certification or a clean chit, but that may not be the case. But still a company or a corporate may go ahead and actually claim that the label has been cleared by government agencies. So perhaps we saw few examples during the COVID pandemic of few manufacturers claiming vaccines and where none existed. The UK Competition and Markets Authority has given excellent guidance around non-financial information disclosures. Perhaps this could be treated as golden rules by internal auditors while they're devising their framework. Claims must be truthful and accurate, should not omit or hide any important information, should be clear and unambiguous. Comparisons must be fair and meaningful with competition. Many times competition is put on the downhill side very unfairly. So it should be meaningful and it should be fair. The full life cycle of the product or service should be disclosed as far as the environment impact is concerned. Claims must be substantiated and supported by evidence. So these are some golden principles which internal auditors can configure in their framework. And the last slide is on critical success factors in conclusion. One is that build a framework approach, as we have seen in the presentation. Creating a framework around data analytics is very important. We try to focus on material issues which are relevant to stakeholders, relevant to investors, decision makers. Develop cross-functional teams and approach. Internal auditors will not succeed unless there is a cross-functional approach within the organization, because the set of information in non-financial information disclosures is huge, large, diverse, and complex. And it has got all the elements of internal as well as external factors. So very difficult for an internal auditor to be a lone wolf and and be able to give assurance to the management without having a cross-functional approach. Data analytics, I would say, is the oxygen for this entire program and framework. If data is not analyzed, it's not tested, I don't think so we'll get to the truth. We should leverage on existing RCMs and controls and try to convert the existing controls by making them greener, by identifying the green impact and testing them, so we can actually build on the existing RCMs and make them more comprehensive and fit for purpose for the entire non-financial information disclosure program is concerned. And lastly, develop a culture of data accountability within the organization. These are the critical success factors. And with this, I conclude my slideshow and presentation for the day. If there are any questions, any deliberations, we'll be happy to do so.
I think it's an excellent opportunity to ask question to Huzeifa, but I have one or two questions, Huzeifa, for you. One is, you mentioned about ESG, which is gaining importance, and the fact has been demonstrated with empirical data that ESG makes a lot of difference to the companies, how they are valued, good performing companies now. But when it comes to the internal auditor, looking at the non-financial disclosures which the company is making, maybe in other areas in terms of controls, the auditor can add a lot of value. But when it comes to the non-financial disclosures which the company makes on the green side, green energy side, most of these disclosures are part of the annual reports. As you rightly pointed out, you gave an example of HUL report, So when these are published in the report, it is only in hindsight next year that the internal auditor would be able to look at it and maybe comment on what the company has stated and how it compares with the metrics you showed in terms of the UK report, how it should be disclosed, and they can only be an advisory role to the management in pointing out what was done, because I think an internal auditor is not consulted before an annual report is published, and I don't think they need to be consulted also. So I think it's only the reputation issue, as you said, risk, reputation, return, which you showed the metrics, which can be, the internal auditor can only enlighten the management in terms of that it may hit your risk, return, and reputation if wrong statements are given, in terms of what you showed in the earlier slide before this. So right. Your take on this subject, on the question which I asked you.
Thanks, Deepji. I think unfortunately the situation is such that we end up doing post facto work on NFIR is concerned. As far as FR is concerned, financial reporting, internal auditors are at the cutting edge, and management wants an assurance from internal auditors. But as we are seeing the situation evolve in the country, there are a lot of boards and management who are quite progressive now and have started demanding assurance around non-financial information as well. So I'm sure that the tide is going to turn very soon in the country. Maybe it's just a question of one more year, where we would see even the regulators changing. The way SEBI is now expanding the scope of non-financial information related disclosures for corporates. Like say for the top 100 companies, they are already bound by the business responsibility reporting formats, where information has to be gathered, collected, and disclosed. Now, more often than not, statutory auditors and external auditors have started looking at this data proactively. Because if there is a safety incident in the organization or a product breach liability that has happened, which will impact the financial statement. So people and boards have started realizing that there is a deep connection between non-financial information reporting and financial reporting. So they want to see the consequences beforehand. And I'm sure that the internal audit charters, the universe of internal audit, etc., is undergoing a change. And for a fact, I know that few accounting bodies globally also are looking at writing standards on non-financial information reporting for internal auditors.
Great. I think that will be really great. There's a question, Huzeifa, on how much ESG and non-financial disclosure is relevant in the banking sector.
Yeah. So it's very, very relevant, because bankers are intermediaries. And they end up influencing a lot of other stakeholders in the society. So quite a lot of large financial and banking institutions are now actually going and disclosing non-financial information relating disclosures in their annual reports on their websites, etc. So banks are also supporting a lot of local communities, and they want to bring out the impact of those local communities. I'll give you one specific example of a listed bank in India, which actually was operating branches and ATMs in a very, very notorious area in the country. And one of the, I would say, the least hygienic areas in the country, where, there was a lot of unhygienic activity happening in that local community area. And the bank took it up as a challenge that if their branch and if their ATMs were to survive in that area, where no other banks, ATMs and branches have survived because of certain local factors. So they created a massive drive within the local community to clean up the area. And they cleaned up the area, they brought the entire local community down, and they brought school children down to the local areas. They cleaned up the entire community, and they cleaned up the mess in the community, local community place where the branches and ATMs were location, and it became a sterling example for the bank. And that was then, I think, replicated by several other financial institutions as well. Also, from a impact perspective, banks do like to influence their customer community. They do like to influence their stakeholders, their vendor community, their employee community. So there are a lot of ESG initiatives, like say from an employee well-being perspective, from a mental health perspective. So a lot of banks are moving in that area. Like one of the leading private sector banks in the country got the award for the best COVID implemented strategy. Now that means that how much they care about their employees. And if they care about their employees, then obviously there is a lot of data around the health of the employees, monitoring the health, measuring the health, overseeing the vaccination program. So there's a lot of non-financial data around the KPI and performance of the bank that can come into the ESG metrics.
Thank you very much, Huzeifa. I think I'll just like to add here 2 points which come to my mind. As you spoke, in the last 2 decades, we are talking about ESG now. We are talking about non-financial measures now. But if you look at the history in the country, last 2 decades or 3 decades, banks have been at the forefront for financial inclusion for the poor sector, for the weaker sector in India. That's number one. And number two is, nowadays, if you look around the world, I think there are very strict norms on lending. Banks have so much taken up that they would not like to lend to certain kind of industries which are not green. Maybe a coal plants or so there's a lot of awareness on that. So I think internally as well as externally, banks play a very big role as far as non-financial sector, disclosures, information, and work is concerned. There's a comment by Murtaza Ghadiali. Thank you for the awesome session, Huzeifa sir. So I think that's a praise for you. Of course, everybody is going to like this session. Any questions? Any more questions, please? I think Huzeifa is here. Let's take advantage of that. Or if you do not have any questions, then I would like to close this. But I would like to just point out that Huzeifa is available with us, even in future. And you can write into us. You can write into Huzeifa. Huzeifa, why don't you just type your this is his email ID, which you can see on screen. So I think all of you can just note this. If there are any questions, you want to talk to him, send in your suggestions. You're most welcome to do that. Huzeifa.unwala@jhsassociates.in, which is where you can contact him. You can contact us and we'll send the message to him. I would like to, on behalf of Sama Audit, I would like to thank Huzeifa for spending time, for taking the effort to enlighten us about the case studies, to share with us the case studies, especially the case studies and the topic, what he talked about, because this is a little offbeat topic. This is something which is coming up where all professionals should be focusing on, because this is the future. This is different. So I think that's very important for all of us. So thank you very much, Huzeifa, for this wonderful session. On behalf of all the participants, on behalf of Sama Audit, I thank you.
Thanks
all the participants for joining us. And I look forward to all of you, the participants, to join us again next week, Wednesday, 7 to 8 p.m. Thank you very much, Huzeifa.
Thank you.
Thanks a
Thank you,
lot.
Deepji. Thank you, everybody. Thank you. Bye.
Bye.